Hey everybody, this is Jose. We are about to get started. We got 40 plus seconds to go. So this is the right time for a quick sound check. If you're into the sessions, what we do normally is a quick message on the chat box, a quick hello. So if you type hello, I know you heard me. So sound is good. And also it's a nice way to get started and to greet everybody before we begin. So please do that. We are starting in 20 seconds, everyone. Thank you so much. How are you, Mark? Good to see you. Five seconds to go. Thanks for the sound checks, everyone. Wonderful. Perfect. That's it. Time to begin. Welcome, everybody. This is Jose Blasco speaking. Today is August 25, 2022. And this is our options trading live session where we're going to spend an hour looking at the markets, looking for opportunities and more. Before we get started, I'd like to highlight the financial disclaimer on the upper left side of the screen. Please read it carefully. It is important information. It's fairly short, so please read it completely. That's what I'm counting on you to do. Please take it seriously. Thank you so much. How are you, Jeff? It's good to see you as well. Agenda for today, for the ones of you that are regular attendees, you know this by heart, isn't it? For the ones of you who are new to the sessions or watching this recorded, so what we do is that we look at the markets, we discuss what's happening out there. From there, we move into looking at trades that we may have running and may need to be maintained or managed. And from there, we move into looking for new market opportunities. This is normally the sequence. Sometimes we vary a little bit from that, but that's the idea. And of course, you guys are more than welcome to interact, to ask questions at any time, and please do so. Okay, so that way we can make the session richer, and I can be more helpful to you if you share what you need. Okay, Joanne, it's very good to see you as well. How are you, Joanne? Very good. So let's get started. So here is our platform top. We're gonna get started now with the market analysis. As you may have felt, my voice is not in the best place today. My throat is actually itching. So I may take it a bit easy with my voice, and hopefully I'll be able to last for 1 hour. But it's been a little bit of a difficult day for me to talk today. Okay, so please bear with me on that. And if you need me to repeat anything because maybe my pronunciation is not clear, please just type it on the chat box, guy. I will take it very positively. Okay, so no worries about that. Just let me know. Anyway, let's begin with the market analysis. I'm going to start looking at the VIX. Thank you, Joanne. Very kind of you to have that message for me. So this is the VIX. Okay, the VIX is currently trading at 22. If you recall the conversation we had last week when we met last Thursday, the VIX was down here in the 1920 area. And we talked about that this was not a super low value for the VIX if you look at the history of the VIX throughout the years, but certainly in the short and mid-term, if you wish, certainly that was a low. And sure enough, VIX gapped up very aggressively, reaching 24.5 more or less until it found that red UFO that pushed it back down, and those multiple UFOs forming that keep pushing it down. Okay, so we are now more or less at what I would call a value of VIX, which is not too high, not too low, is somewhere in the middle. And in that sense, in that type of market scenario, from a volatility point of view, I have no preference on looking for credit opportunities or debit opportunities. And again, many of you probably know, if you have been trading options, that sometimes the VIX is in the middle or low or high or whatever. And wherever the VIX is, you can always find stocks that are very low IV, very high IV. And, in a way, you could ignore the VIX and look for stocks that have their own implied volatility condition that could be a little bit of an extreme and give you a market advantage. Well, that's true, and certainly it's a valid way to do it. As you know, my trading style, if you've been in the sessions for a while, I'm more in the picky side, if you wish. So in order to add a bit more odds in my favor, I like the VIX to be in the right place. So if, let's say, the VIX is low, and I find stocks with low IV as well, well, the IV of the stock is likely going to rise because it was low. But if the VIX is low, then the IV of the market is likely to rise, which helps for the probability of the IV from that stock to also rise. So that's why we look at the VIX within our market analysis as we begin the sessions every time, because again, in that picky mode, you would want to be a buyer of options when the VIX is low, you would want to be a seller of options when the VIX is high, as well as make sure the stock also has low or high IV, depending if you are a buyer or a seller. Now, this long explanation is to tell you that today we are in the middle. So because we're in the middle, it's not a great advantage to be a buyer. It's not a great advantage to be a seller. So, of course, we're going to be looking for IV conditions from the stocks themselves, and we'll rely on those more than the implied volatility of the market. We may have the volatility go against us by a little bit, but hey, you know what? We'll have other components of the trade hopefully working our way, such as the direction of the stock, the gamma, and things of that nature. Okay, so, well, it's been a little bit of a long comment. Really, I have nothing to say about the VIX. It's in the middle. So, whatever we find based on the implied volatility of the stocks themselves, that's going to dictate the type of trade that we would take from an option strategy point of view. Now, from a directional or non-directional point of view, now we need to look at the S&P and do our S&P market analysis. Okay, so let's begin. So let me zoom in here, and maybe if we had to title today's session a name, if every time we do a live session we had to give it a title, maybe today the title would be Finally. Okay, that would be the title for today, because what a massive, amazing, lengthy climate out of probabilities. Okay, totally out of what probability would have suggested. But again, in the end, we had a change of climate. Went to red. Notice that the climate in which we are currently, it's a non-confirmed climate. Okay, it's been lasting 4 candles out of 3. So statistically speaking, we are more likely going to reverse back up and go back to blue than continue in the red. And that is true from a statistical point of view, but also because of the fact that the climate never confirmed to the downside. So, if you were to think of technical analysis, classical terminologies, such as, impulse, correction, this kind of thing. So certainly we are in a corrective environment. And after the correction, what would be expected would be another push to the upside for another blue climate. Okay, and this is also accepted when we look at our implied volatility of the calls, which is the blue line, which is above the implied volatility of the puts, which is the gray line. So we have a market environment that by looking at options prices, we deduct that there are buyers in the market. Okay, now, when we look at those two lines, the blue and the gray, we discussed this in the past, those lines tells us if we're in a market environment where there are buyers in the market or sellers in the market. Right now is buyers, but that doesn't tell you at what price. Okay, because options trade at multiple levels, because there are many different options contracts, one per strike, and there are many strikes. So we know we got buyers in the market, probably around out the money, because the calculations of implied volatility, they are weighted. It's normally 3 strikes above and below at the money strike, and is weighted times delta. So in other words, these calculations have to do with options around price, but not necessarily exactly where the price is. So in order for us to see the S&P go up, we may need to see it go down a bit before it goes. But we know that if the S&P was to go down, at least given the current market conditions, which could change, but given what we have on the screen real time right now, so we have buyers in the market. Okay, so of course we don't know where they are, but that's when the UFOs and all the other tools comes into place when it comes to timing our trades, defining valid entries and exit points to make us more precise and hopefully enter at price points where the buyers are. Okay, but not only you need to find out what those price points are, you also need to make sure that there is the willingness of buying or the willingness of selling. So we have that. Okay, we have the buyers in the market, and the red climate seems to be reaching its end, and the moment it changes to blue, obviously it's not going to be today, it's going to be either tomorrow or Monday, something like that. So the moment it changes to blue, then changing hat and becoming now aggressively long, to me would make a lot of sense. And notice I said the word aggressive. Aggressive doesn't mean use all your money and take with one trade. It doesn't mean that. It means no hesitation on going long. Of course, no hesitation with your risk management rules. So calculate the position size, know how much your risk per contract, have a trade plan where you set the most you want to risk per trade, and make sure your trades don't surpass that risk. So of course, aggressive doesn't mean reckless, okay? But aggressively long certainly means that we have all the conditions. The moment we have a blue dot on the climate, we'll have all the conditions in place to be looking for market opportunities to add positive delta to our portfolios and ride this move to the upside, which based on our analysis and the probabilities that come from the analysis, that move to the upside is likely going to happen. Okay, but now we need confirmation. Okay, we need confirmation, and the confirmation will take place the moment the S&P proves that EMA, which is reacting very well to it today, it kissed the EMA and went back down, like it happened many other times. Okay, that's why we have the EMA, isn't it? So the S&P needs to prove that it's going to be closing above, right? This is when the climate will change. And again, this is looking also quite likely given the fact that we have an Elliott wave turning point indication on the daily time frame of the S&P. Now, again, remember that indication is showing real time, but that indication is not valid until the candle is closed. So in a perfect world, we got a candle close with an Elliott wave indication, and the close is taking place above the EMA. So we also have a change of climate, and therefore you can start acting tomorrow on the plan I am putting on the table right now. If we don't have that, then you're going to have to wait until Monday, etc., until you have that change of climate, okay? Because doing the trades without the change of climate is basically a little bit of a hope, or a guess, or both, hoping to guess or guessing to hope or something like that, okay? So we don't do that. We trade based on evidence. And in case we are wrong, we manage our risk knowing the type of position we build and the risk which is attached per contract, and only use X amount of contracts that makes us to not surpass our risk, our desired risk, which is in our trading plan, okay? Joe, good to see you, my friend. So this is the market analysis that we have, okay? So therefore, really, doing non-directional trading at this stage makes a lot of sense, okay? And therefore, just to give a little bit of variety today, what I would like to do is to look at iron condors, okay? We've been exploiting the world of double calendars in the prior 2 weeks, I believe it was, or even maybe 3 weeks. So let's exploit it today from the point of view of iron condor, which is credit instead of debit. And then what we'll do is, if we have extra time, then I'll look for longs, not because they are to be executed today. I mean, if you were very aggressive and that your plan allows you to do it, so then why not, if that's your plan? But based on what I do, based on what I just mentioned, so those trades will be to be executed in the following days, the moment the climate is confirmed to be blue. I would still like to do a little bit of that exercise to kind of like, show you the process, and that way you can do the practice by yourself, the days we don't meet, okay? Cool, okay, so now, before we get into looking for trades, I'm going to be looking at our current position, which is Nucor. We have work to do here, isn't it? So if I look at this trade, overall with the 2 tweaks that we have done so far is basically breaking even real time, okay, which is good. Let me go ahead and show you the risk graph for this trade. Okay, so this is where we are at. Okay, so we are basically breaking even. We are right there. Okay, right here. Okay, at the zero line. We are making $2 per contract as we speak right now, right? So again, we are here waiting for an increase of implied volatility, but in the meantime, this is a double calendar. I didn't say it. In the meantime, those options that expire on August 26, which is tomorrow, they are likely going to be, in the position where we need to roll them. Let's take a look at where is Nucor on the chart. Okay, and Nucor is here, trading at 141.53. So if you recall, that stock was going higher. We entered here that day, and the stock went higher. Then the stock went back down more or less to where we started, and now the stock is, more or less here. So we are within the range. We are doing the right thing. Remember, the purple lines are where we have our options. That's the 150 strike, where we bought a call and sold a call. That's the 125 strike, which is where we bought a put and we sold a put. And those options that we sold, which is the 150 call and the 125 put, those options are likely going to need to be rolled, because probably we are now already facing distorted Greeks, which means that all the profits made on time decay are probably, enough and ready to roll to the next week expiration and collect more credit to lower the risk of the trade and keep massaging the trade as we are approaching October 21st, which is the expiration date. Now, I want to say one more comment before we do it, which is the fact that the stock went down aggressively and then started going back up higher probably gave you an opportunity, if you were looking at this real time, probably gave you an opportunity to already take care of the call side of this trade. I'm not fully sure about that because it was a few days ago. So Greeks may not have shown as distorted yet, but maybe. So I'd love you guys to comment on that if anyone was checking and you had an opportunity to roll those calls in the prior days. Joe, you did. Wonderful. Wonderful. Perfect. Love it, guys. This is exactly what I love because, in the sessions we spend, both Josip and myself, lots of time explaining the things we do and why we do it the way we do it and what is it that we pursue by doing what we do the way we do it. And you get my point. And the ultimate reason is so you can do it by yourself. Okay. We'll indeed miss you very much if you end up not coming to the live sessions. But at the same time, it would put a smile on my face to know that you don't need to come to the sessions to do your trades. And I would say, please keep joining because, again, trading is more than just knowing what to do. It's also trading psychology. Markets conditions may be diverse. Look at the pandemic, for example. So we always learn, including me. Okay, I also always continue my own education. But at the same time, you may get to a point where you are self-sufficient. You don't need to attend sessions that often, okay? And that is really the ultimate goal, okay? So make sure that you ask questions during the sessions precisely to get to that point, okay? Good job, Joe. So anyway, so what do we have? If we start looking at the 150 call, so that call provides us with, let me redraw this, 2 to 7 cents of premium with a theta of 13 and 1 day and a half to go. So let's call it 2 days. So 2 days times 13, that's 20 cents. And that makes no sense because we only got 2 to 7, right? So the Greeks are distorted for the calls. What about the puts? Well, for the puts, we are dealing with 3 to 2 cents and theta does not even show up. So obviously it's distorted. Okay, so both the puts and the calls are distorted, which means that we need to get rid of those calls to sell those new calls that will pay 60 to 70 cents, and we need to get rid of those puts to sell those other puts that will pay around 30 cents. Okay, and we're going to take all that premium in, which is going to lower the cost of the trade by close to $100 based on those values. So let's do it. Okay, let's do it. I'm going to bring Thinkorswim in. We have new core here, and I'm gonna start with the put since it's there, and I'm gonna right click to create a rolling order, and we are going from August 26 to the next expiration date, which is September 2nd. Same strike, same units. Okay, so get rid of the 125 that expires in August and sell the one that expires in September 2. That may be done for 24 cents at the midpoint of the spread at this time. So I'm just gonna try that. And on the call side, we just got filled at 24 cents. Thank you very much. And on the call side, we got the 150 call. Okay. And we're going to do the same. Create a rolling order, sell. And this seems that it may be done at 63 cents. So I'm just going to go ahead, go for it, and see if I get filled as well. And then I'm going to add all that information in top so we can evaluate the trade better. Okay, I'm not sure if Mark, you have typed a message because I see Joanne, you said that. I was wondering that as well, Mark, but I don't see Mark message. So maybe there's been a little bit of an issue with the stream or something. For whatever reason, I didn't get that message. Oh, by the way, I'm just realizing I didn't stop the scrolling ticker in the bottom part of the screen. I just got rid of it, so we have a bit more space on the screen. You guys feel free to tell me if I ever forget to do that, or any of the instructors, okay? Anyway, so let's go ahead and go back to the risk graph. We're gonna compare spread, and what I'm gonna do now is copy the primary and edit the spread with the new values that we have got. Mark, I checked, but I did not do the roll. I don't know if rolling as soon as one can is better than waiting until closer to the expiration to gain more time decay. Well, but if the Greeks are distorted, right, so you would get more premium from the next expiration date. So the speed of time decay will not be as fast, because as you are pointing out correctly, Mark, the closer to the expiration date, the faster the time decay, right? Let's be proper. The higher the theta value, the higher the absolute value of theta, because theta is negative. Okay, now it was proper. But at the same time, the total quantity of premium would be more if you roll at the time, unless you get lucky, which is you close the option and then the stock rallies all the way to the call, and then you can sell the call for so much more instead of you sold it at the time. But then that's called being lucky, isn't it? So again, the idea of the rules that we use, and in general in trading, the rules you want to have are rules that don't get you thinking too much. Because if you are thinking too much about the action you need to take, you just open the door wide open for trading emotions, okay, and psychological impact, given your biases or short-term memory of a prior trade you have taken. So, as you have heard me say many times in the past, just following the rules is probably the best you can do, right? And if you would like to have a different set of rules, so then backtesting is what you should do to evaluate the outcome of a different type of rule. And if that other rule seems to be better for you, then change the rule. But instead of having a rule which is maybe too complex, or give yourself too much of wiggle room when it comes to how to deal with a rule, and then, again, you open the door for trading emotions, okay? So careful with that. It's a very valid point, Mark, and I get it. I totally get you. But at the same time, the way you want to trade, you want to have a carefree state of mind when you trade. That's what you want to have, okay? You want to not to care, okay? I'm not saying to be reckless, but just to not to care, okay? Just like that. Anyway, so we are moving everything to September 2nd. And on, let me see, go back to Thinkorswim if I got filled or not. No, I have not been filled on the put side. So let me replace the order. Maybe we'll go for, I'll try 60 and see if I get that. Again, don't be too aggressive yourself. You know that normally I push it a bit harder because I want to get filled so I can demonstrate more trades in the future. Okay, so 24 cents. Okay, 24 cents is what I got for the puts. So let me add 24 cents to the put side. So the put side got 93 cents. Okay, so just to be visual, not that we need a calculator, but just to be visual. So if I got 93 cents already, and today I collected additional 24 cents from the roll, so that is equivalent to a total collection of premium of 117. Which is what I just got on the calculator and just type here. Now for the call side, I have not been filled yet, and if I don't get filled, then I cannot do anything. So I'm just gonna push it, okay? Please don't do what I'm about to do. I'm doing a market order just so I get it filled so we can continue with the lesson for today. Okay, so hopefully, okay, I got filled at 57 cents, so please don't do that, okay? I'm pretty positive you can get more than that. But in my case, I got 57 cents. So again, the same math that we did before will now be done like this. So on the call side, we already had 171. That's what we got, right? And now, when you look at TOS, we just got additional 57 cents for the roll, right? So if I take my 171 and I add 57 cents, so now we are talking about 228, which is the total amount of premium collected on the call side, okay? And when I click OK, so now this trade, it's $820. Notice how the risk profile, which is orange, is very similar to the blue risk profile, which is what I had before. But notice what are we doing here to the risk of the trade? We keep shaving it. So this trade started with $1,000+ of risk. Now we are down to $820, okay? And of course, we are now waiting for time to pass, more collection of weekly expiration dates, premium, and ideally implied volatility to rise, especially as we're approaching earnings, and this is going to happen, okay? If volatility rises, all this green area will appear, and the trade will become greatly profitable, okay? So we are massaging the trade until we get to that point, which is, we still got time to go since expiration is October 21st and earnings is the day before. So I'm just pasting here the tweak that we just made, okay? And therefore, my trade management for today is done, and now we are ready to go and find trades. Mark, so as soon as the Greeks become distorted, we should roll That's the rule. Yeah, that's the rule I employ. That's the rule I've been sharing with you guys. And if you guys are, comfortable embracing such rule, so that's what you're supposed to do. If you want to tweak the rule, again, not a problem. Again, there are many ways on how to trade that make a lot of sense. My only thing I would say here is make sure you have done some backtest, okay, just like I've done myself. And that way you become aware of what the methodology is supposed to produce. So you act with decision, there is no hesitations. And also when things go well or when things go wrong, it's not like it's a surprise and you don't know how to react, because when you do your backtest, you realized what was the possible outcome of such actions, okay? So keep all of that in mind in your trading. Joe, I missed your message. The all call was down to 2 cents. I think the put was down to 6 cents, so subtract that. Got you. Yes. Yeah. Yeah, exactly. That's correct, Jeff. Good. Perfect. So we have that, okay? And therefore, again, time to go back to the charts to begin our analysis of new opportunities, okay? And again, we're going to start the day looking for iron condors, okay? Now, before I even begin, we've seen that before. The VIX went higher, but it's not super high, okay? So as we get picky with filtering stocks out, okay, we may get very few results, and then, I will open the door to more flexibility on the filtering to get more results. But I want to start with very demanding results, like always, with continuous implied volatility mean to be greater than 80% of its range. Okay, I'm going to start with that, which is going to produce very little results, as you can see. Okay, but we're going to start there. So stock filters, I don't need anything here. Scan, I need to import my list. Again, and this is another thing I do that you don't need to do, really. There are many other options contracts that are okay to trade that are not part of the penny increment list of stocks. Here, we're going to look for neutrality. So neutral, yes. For earnings, we're going to exclude anything 30 days or less. Actually, let's do 15 days for iron condors. Then for auto climate, it's disabled. So let's scan and see what we got. And we've got nothing. Okay. Again, I was expecting that. We talked about it before. So what are we going to play with? Well, in order to find opportunities, playing with the timeframes daily and weekly, and playing with the way on how we find high volatility conditions, which we have 3 techniques, isn't it? Technique number 1 is to look at continuous implied volatility greater than 80. Technique number 2 is to look at the implied volatility mean minus the historic volatility is above 2 standard deviations. Okay, let's take a look. And now we have some opportunities. Okay, and then the third technique, okay, would be to look at the top increase in CIV mean. Okay, top increase in CIV mean in the last 5 days. Okay, so that would be, this is normally the one you get more results. Let's take a look. Yes. Yeah, okay. But again, I like to start picking. So this, of course, has me use a bit more of planning time, but also helps me to find better trades, isn't it? So I'm up for that. Okay. Will you use TSL neutral? Yes, that's what I have. Okay. TSL neutral, both on the weekly and the daily. You're correct. That's the way to do it. So let's begin. Let me see. $71 stock all the way to 192. Okay, all those stocks are fairly liquid. So, okay, I'll start with Qualcomm and see where we go. So here's Qualcomm. Okay, we are looking at these charts so we can understand better our expiration date. Our expiration date is there all the way in November 2nd. So if we do this trade, it would be a trade for 2 months. It's a 2-month iron condor with expiration date up to October 21st. Okay, that is, we need to be out of the trade before earnings. With the double calendar, we want after earnings, but with the iron condors, you want to be out before earnings. So expiration date will be maximum October 21st. Okay, so let's take a look at the skew with Qualcomm. And let's look at September 2nd, September 9, September 16, 23, 30, and 7, and October 21st. Okay, all of those are the expiration dates that we could use. Wow, it really catches my attention that the orange line is very, very high compared to many other expiration dates. So that may be the one that produces the best effect. Yeah, that could be. The orange line is quite higher, especially on the put side. Yeah, I think so. So this is looking good to me. The fact that long-term expiration dates have plenty of implied volatility. I mean, we know normally the front wick, which is the red line, typically is going to be the one with the greatest implied volatility. And then as you go out in time, you get less volatility. This is the classical, thing that you would see. But in this case, you can see how the orange line is kind of breaking that norm a little bit. Okay, especially on the call side, on the put side less, but definitely on the call side. So I'm inclined to be honest, to look at all those expiration dates and see what's going to be best. Okay, and if you don't mind, give me a second, guys. Sorry about that. So let's go for it. Okay, I'm gonna have to mute myself one more time, guys. Sorry for this. Okay, back to you, my friends. Hopefully, I will be good. So anyway, I am floating this. Okay, so we can go back to the chart. And what we're going to call now is the spread select tool. Finally, we did a session on spread select last Sunday. We did a top session where we were discussing this tool. So this should allow me to really move quickly here. And we are looking for short-term condors. We said we're going to look for expiration dates starting from September 2nd all the way to October 31st. So we're going to do that. We're going to start with a 144 strike. We're going to look up and down. Minimum is 1 and maximum, this is a $145 stock. I'll go all the way to $3 maximum of risk. Okay, and with that, we will also load our filter for iron condors. Here we go. And with all of this in place, now let's build 99. And let's see what passes and what fails. Okay. So using September 2nd, we have a few passes. Okay, so because we have a few passes, let's go to the chart and let's take a look at September 2nd and see what is the top value and the bottom value, statistically speaking, which is the dark blue line, which is 156 and 134. So 156, 134, so we got 151, 153, and then we move into September 9. So there is not enough premium on September 2nd, and therefore we are just going to move to September 9 to do the same analysis and sort it. Here we go. And we got a few more cases of September 9. So let's find out on the chart, September 9, here, what is the statistical range. So it's 160 and 130. Okay, so 160, we got 158. And then we move into September 16. Okay, so September 9 is not giving us a go ahead. So we look at September 16. Okay, and September 16 is giving us here. September 16 is here. September 16 is requiring 163, 127. So 163 and 167 No, not working. And that one, we commented on this in the past many times, actually. That one is a monthly expiration day. Typically, those are the ones that work the least because there is less premium. Okay, so September 23, let's take a look. Okay, so with September 23, we are talking about September 23. We are talking about 166. We got 166 right here. Okay, and 113. 75, 77, 108, 111, 193, 1. That may be a good one. Yeah, $5 of strike price increments though. Okay, so even we set maximum 3 because the option chain doesn't provide that, so you went to the next one, which is 5, because you need at least one strike difference, and if the next strike is $5, so then it has to show it. It has to show it, right? So we got 166, 113, and that is 166, 125. So definitely that is favorable and that is acceptable. So I'm just going to right click to risk graph it, and I'll come back to it later. What else? 166 and 118. Oh, wait a moment. Silly me, guys. Silly me. Silly me, my friends. This is October 21st. Okay. In other words, nothing in September 23 or September 30 or October 7 passed. So it went all the way to October 21st. So then I guess that we're not going to be able to accept it, because now we will need 175. And I don't think I've seen 175. I've seen 171, and then it fails. So yeah, so Qualcomm is not going to be a good, valid one. So let's move to the next one. Okay, guys, comments, questions, and if all is okay, just type okay. So that would be good. So I'm going to go from bottom to top just for fun. So Bristol Myers, let's take a look. Okay, I like to see Bristol Myers falling relatively hard today. That may spice up a little bit the options prices. Yes, so we can see the red line way beyond the blue line. So I'm very happy to see that. Earnings are happening on 10/26. So again, 10/21 is the furthest out we can go. So the exercise is going to be very similar, but we are doing this with BMY. And if we look at the skew, is there anything for us to understand? So BMY, it's taking a while. Okay, no, it's still taking a while. I'm not sure why. Slow connection for whatever reason. So in the meantime, I'll start putting this together. So we're going to be looking at expirations from September to October 21st. That's the same as before. And that's $71 stock. So definitely from 1 to 2. 0.5, you can go for that too, but that would probably imply those strikes are not going to be too liquid. So you know what? I'm just going to leave it easy, simple, $1. Okay. Okay. So for whatever reason, it's not loading well. So I'll leave it alone and I'll just go for it manually. Okay. So we are now building 99 Condors. 99. Exactly. And let's filter this. If everything is good, my friends, please let me know everything is good, okay? That would be very, very helpful. So September 2 was showing pass, but now it's showing fell, okay? So I guess that it's borderline with passing or failing. Yeah, what's happening is that the bid price is only 21, so that's not good. Okay, so then September 2nd is not good enough. So we're gonna continue with September 9. So sorting the whole thing. So we got 4 cases of September 9 that work, the 4 cases on the top. So let's take a look at September 9 on the chart, which is right here, and see what are the values for the red line is 76 and 67. So we are looking for 76. Okay, we have 73, 74, 75. 5, that's September 16, okay? Now, because of what I told you before and experience, I'm just going to skip the monthly. Okay, I'll move straight into September 23. I'm going to go for 9. So we're looking at September 23 right here. And the value we're looking for is 77 plus. So let's go ahead and sort this. We're looking at 77 plus. 76 something. 76 something. We didn't get the 77, okay? So yeah, I mean, the fact that the implied volatility is so high makes the range very wide, which makes it a bit more difficult. But at the same time, the fact that the range is wide also means there is more risk. So we do need more premium, okay? So do not relax, okay? Do not relax and be like, okay, I'm going to take it with a little less, it's fine. There's a reason why we do the things we do the way we do, and why we don't have a crystal ball that makes all our trades to profit. There is a reason why we do the things the way we do, isn't it? Anyway, so September 30 is right here, and the red line is 78 plus. So we are looking at 78 plus, 78 plus. We got 77 plus, 77 plus again, and then we are moving into October 2nd. Okay. So it seems that October 2nd will need to be the one. And this is kind of what I was telling you before, that because the VIX is in the middle, it's more difficult to get the goes, and you often get more no-goes. Okay, so October 2nd. So October 2nd is here. So we are talking about 79 plus. Okay, 79 plus. No. 79 plus. And now we are inside the fail territory. And notice that there is no October 21st pass, okay? So it fails here, which means that October 21st does not provide the premium we want, okay? Okay, so next one. So far it's going to be, it's been 2 no's, okay? Twitter, let's take a look at Twitter. Yes, pretty interesting volatility, earnings on that date as well. So we are talking about 10/21st. It's basically copy paste. Hopefully the outcome will not be copy paste, and we'll have an accepted trade with Twitter. Wow, looks like the implied volatility for October 21st is very, very high. And yeah, also September 23 looks pretty okay. Anyway, let's do the same. Let's go for Twitter. And we're going to do September 2, 9, 16, 23, 30. Okay. I will ignore October 21st, if that's okay, and September 16. Okay, because they are the 2 monthly expressions, and normally they have a little bit less spice. That's kind of like a normal thing, okay? So now Twitter is a $40 stock, so I'm gonna go $1 to $1. Okay, and we're gonna build 99 of those. And let's begin with September 2nd, which we do have some passes. So September 2nd, we are talking about 44 plus. Do we have 44 plus? No. So September 9. September 9. Okay, we have a few. September 9. September 9 is here. We are talking about 46. Okay, so we are looking at 46. 46.24. Oh, that's September 23. Okay. Yeah. So September 23. Okay. We sort September 23. So September 23 tells us 48 plus. So do we have 48 plus? Do we have, no. And then we are getting into October 47, where the most, well, we got 48 something, but you know, October 7 is going to ask for more. So yeah, not working, not giving us the premium we need that justifies the trade based on the rules. Okay, and also of course Twitter is a very low price stock, $40, but again I wanted to give it a try. Okay, so let's take a look at Philip Morris. Where is the implied volatility? Okay, pretty high. That's good. Earnings also all the way after October 21st. So actually before October 21st. Okay, so the most we can go is October 7th. Okay, October 7th is the maximum we can go with Philip Morris. Okay, and these trades take a little bit of time to plan, but it's a good thing, because what happens with these trades is that then they take a long time to be in the market, right? Because we take them and we keep them during multiple weeks. So I guess fair enough. Okay, so this is a $90+ stock. I'm gonna do 1 and 2, good. I'm gonna do 99 of the spreads. So this is a very relaxed type of trading. It's not intraday trading. The market opens, you start building the trade, and when you get the yes, then you just execute, and then it's just a matter of managing the trade for a few weeks. Okay. So September 2nd, let's go ahead and look at what the requirement will be for September 2nd. So we are talking about 101 plus, almost 102. So do we have that? No, we have 100, and that's it. Okay. Okay. So then we're gonna go for the next one, which is September 9. Okay, and see if that one will pass or not. Okay. So September 9, which is right here, requires 103.4. So do we have 103.4? Well, here we got 107. We don't have bits, so I'm not happy with that. 107, no bits. 107, no bits. 107, no bits. It's weird. This is weird. Yeah, it's what it is. Yeah, and then we are moving in September 23. Okay, so we're gonna have to look at September 23. Okay, September 23. And September 23, which is going to be somewhere here, requires 105.7. So do we have 105? Do we have 105? 104? 104.40? No. So finally, we got September 30. Well, not finally, we got one more after that. Let's see if this one will do. Come on, you just want to trade, isn't it? September 30, which is here, requires a range up here at 106.71. So 106 plus. No 106 so far. $105, and that's October 7. So my friends, it's not looking good, guys. I'm gonna skip the October 7 as well, because I can see there is actually less premium in that one. Okay, so let's go back to the chart. Okay, we gotta persevere a little more until we find the trade to be approved. Okay, so next one, Leonard Corporation. Let's take a look at this one. Here we go. So earnings here are happening on 9/19. So we are talking about 9/16 maximum. Okay, so this is a much shorter term play. So Leonard 9/16 maximum. Okay. And this is a $84 stock, so we'll do 1 to 2. Okay, I'm okay with that. And we'll do 99 spreads. Sort it. See what passes. So September 2nd, we have a few passes. Let's take a look at September 2nd. So the red line, it's 89.8, 89.4, 89.4. We got 95.63, but we got missing quotes. Yeah, so I won't trust that one. We got 90 missing quotes. Oh, wait a moment. This is September 9. Yes, that's September 9. So let's check September 9. Okay. So September 9 would require a range of 92. So we are looking at 92. We got 95, but missing quotes. We got 90 is no good. 96, missing quote. 96, 95, 96. Okay. A little bit of a challenge for our patience here. Yeah, 96, missing quotes. Yeah, many theoretical passes, but then when you look, that one is almost 91.25. It's a shame because that one got quotes for everything and fair spreads. 91.28, 96, and missing quotes. Okay, yeah, so we got to 91.28 when we need 92, so almost, but not there. So September 16 is our last choice. Let's see, and that one I would expect to be disappointing because of what I said before, even though being the closer to expiration, so we may have a surprise. Okay, so with September 16, we would need 93 plus. So do we have 93 plus? 93.2. Okay, so I guess I could take that. 45 to 60, 55, 70. I could take that. 93.20, and where's the bottom part? So the bottom part is 74 something, and that one is 74 something. So this one is valid. Okay, so we'll put it here and analyze later. Do we have more? 93, 93.25. Yeah, 93.25 and 75. But wait a moment. For the 16, I said the bottom needs to be 74.8, and that's 75. So the 75 is not good. So we got 94.75, and then we get into fell. Yeah, and then fell. Oh, actually, and there are more passes here. Interesting. 93.77. Yeah, and then we get into the fail. Yeah. So there is only one trade that passes our criteria, which is this one. This is a trade that will produce $20 of credit. The spread is $1 strike price increment. This is a perfect trade if you wish for practice purposes. We had trades like that in the past where you don't make too much money with them, but that's very good because they have very little risk, and for practice is a good exercise. So that's the one we found, and that's the one we're gonna execute. Okay. Break even at 93.74. Yeah, so all of this was fine. So now let's take a look at UFOs, because of course all of these require of UFOs as well. So we have the upper part of the range and the bottom part of the range here with the red lines. And now we're gonna dive into an intraday time frame, see what is the probabilities we get with the UFOs. With 50, so it's good. Okay, and now the idea is to look for green UFOs below and red UFOs above. Okay, so, well, those UFOs are located very far away. So that is far from ideal. On the upper side, extremely far away. So that is really, really far from ideal. So we're going to have to, from ideal. So we're going to have to look at other time frames, okay, to see if we find UFO. So the normal practice is to go up first, and if we don't find it, then we can go down. So I'm looking at the 89-minute time frame. Again, the purple lines we are drawing with the UFOs are critical for the trade management, isn't it? So, oh, great. So we have a UFO there. It's 45%. Okay, so that we won't take. So I'm going to move to 144-minute time frame. So 55, 89, 144. And with 144, we got 55%. That's good. That allows me to bring my purple line closer. This is great, even though it's still very far. The upper part is also good because it allows me to bring my line closer too. So that's nice. We got 2 UFOs above, is the minimum. We got 1 below in this time frame, but remember on the 55-minute time frame there were more. So it's not like there is only one. There's only one on this chart, but there are more. Okay, so that's acceptable. But still, if you look at the distance between the red and the purple above and the red and the purple below, there is more distance below. So I'm going to look at the 233 to see if I can adjust this a bit better. Same one, 51%, that's good. Same one on the bottom part. On the upper part, what we got was better. Okay, so I'm going to look at 34 minutes. I'm going down the time from now. So on the upper part, we have this UFO here, which is near. So I'm okay to do that. I'm actually very happy to do that. On the bottom part, multiple UFOs. But that one is right here. Okay, so that's problematic. Okay, it's making it less ideal. Okay, on the 21-minute time frame, we have 56% probabilities. That's fine. Good, perfect. On the 21-minute time frame, we found a UFO here. Okay, good. So if I go back to the 55-minute time frame now, I think it's going to look pretty okay. Yes, look at that. We got the red and the purple, and they are more or less equal distance and fairly, fairly placed, not too far. So you have this area between the red and the purple for trade management purposes, isn't it? When the cone line is crossing over the purple line and all of this, we have actions to be taken. We need to roll the puts, roll the calls, butterfly it, isn't it? So all of this needs to be kept in mind, and it's very important to have those purple lines in place so we can do this type of trade management. So we are going to be entering the trade right here, okay, at this moment in time. The trade is valid, okay? It's going to be the 94.93 call and 75.74 put. That's going to be the iron condor that we're building. And this is Leonard Corporation, so I'm going to bring TOS. Where is TOS? Okay, here. And we're going to load LEN. September 16. Okay. And we said 94.93 on the call side. I need to add a couple more strikes to see 94. Here we go. So we're going to be buying 94, selling 93. Okay. And then on the put side, we said 74, I think it was 75, 74. So I need to add one more strike. Here we go. So we're going to be selling 75 and buying 74. Okay. If we do all of this like that, it produces 20 cents of credit, which coincides with what we got here. Okay. And this is acceptable based on the rules that we have for our condors, because we need a minimum premium of 15% of the raw risk, right? So what is the raw risk? The raw risk is the distance between strikes, which is $1. So $1 times 100, that's $100 of risk. We want to collect at least 15% of that in premium. That is $15, okay, which is 15 cents. And this trade seemed to provide 20 cents, which is more than 15. So it's acceptable. And by the way, we don't even need to worry about that because it's built in the filter, right? It's built in the filter with a spread select tool. So those trades, that's why the pass or the fail, that's one of the criteria, which is the return on investment, right? So then we're good. So let's do this trade for 20 cents. And let's see how easy we get filled. I would say it should not be too bad because it's the monthly expiration date. But of course, it's going to require a little bit of patience, which I have no time because the session is to be concluded in 1 minute time. So I'm just going to go with a market order. I would say you guys take it very easy, please. You know, I always say, but it's every time, you know, I'm thinking that someone may be watching the video recorded and not listening to me. Please, guys, if you're watching this recorded, I'm using market orders for the only purpose of getting this in so we can discuss it in future sessions, but that's not how you fill your options trades. Never use a market order. I got 10 cents. That's ridiculous, okay? I don't care because, you know, I want you to understand the process more than, you know, show off results in the account. That's not what I'm looking for in these sessions. It's more about you understanding how to trade, the process, and so on. But that's a great example of what not to do, isn't it? I got half of what was available. I got killed on slippage. So please do not use market orders. So I'm going to edit this so I can keep it on my positions panel. So we got 50 and 45 on the call side. So 50 and 45 on the call side, and we've got 60 and 55 on the put side. Which is going to give me a credit of 10, which is what I've got, okay? And now I'm just going to right-click, copy this to the positions panel so we can discuss this in future sessions, okay? So I have it, okay? Cool. So guys, questions, comments, how is it going? How was it? Is the process clear? Okay, because the idea is that now you can continue replicating the same with other stocks. And by the way, because of my picky approach to trading and also to be very careful for you guys, because this is an educational session, isn't it? So I want to make sure that I don't add too many ingredients that could be problematic, especially for the ones of you that may be in learning stages, which I know is not everyone, but it's indeed some. So one of the things I do is to use the penny increment list, right, for options. That, because those stocks are so liquid and so nice, so that often caps a lot of the premium which is available. So if you guys are open to experimentation when you do your homeworks, okay, following the same process I followed, if you were to not to use this type of list and you scan, you will find many more stocks where some of them are symbols that you may not know for sure if they're liquid or not, like Citrix, for example. Guess what? Some of them are liquid. They just not trade in pennies. They trade in nickels, right? When you enter your options prices, it need to be 0.05 at a time. But there may be liquidity, and those options often have more spice in it, and you may find opportunities that are a bit juicier when it comes to making money, while my focus is more to guide you into understanding the process and how to do it. When you do your homework, you may want to experiment with that as well. And feel free to tell me in a future session if you do, okay? Now, before we go, guys, I have a special smile on my face today, even though my throat is itchy, which is not fun. Again, you will receive an email tomorrow, but since you guys are live here with me, I'm going to show you this, okay? You may see it, you may not see it. Here we go. You may see it, you may not see it. Something like that. Well, you kind of know what it is, right? It's our first book, my friends. Okay, we are publishing it on the 31st of August officially. As you can see, it's printed. I have it in my hands, so the book already exists. And we are doing a pre-order process that starts tomorrow. And then the book will be officially on sale on the 31st of August, which is next Wednesday. and you could buy it either in paperback format or in ebook format. And yeah, so I'm super excited. I have to say a super thank you, because this would not have happened without Becky Heyman, which we've done this together. It's been teamwork between the two of us, and it's been super fun, and we are both extremely, crazily, amazingly excited. So hopefully you guys will enjoy it if you have time to read, which I understand may not be everybody. But again, you receive an email with more instruction on how to get it. You can just go to Amazon and type the title of the book. Hopefully you can see it. It's Mystery to Mastery series. Okay, so it's going to be a series of books. The first one we'll release is FOREX. And so if you type Mystery to Mastery, so then you'll find the book in Amazon or any other bookstore. Okay, you can buy it in many places. It's already available. Again, it will be available on August 31st. Before that date, starting tomorrow, ebook only, and next Wednesday, all formats. Anyway, guys, I'm very excited to share this news with you. Thank you for staying with me for a few minutes to share the joy, and very appreciative as well, as always, that you guys are part of what we do, and we have good news. So again, it's very enjoyable for me to share that with you all. So thank you for that. See you in the next one. Keep up the good work, everybody. And as you know, anything you need, guys, we are one email away. So make sure you do that, okay? Take care, everybody. Bye-bye.